Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Rick Rule is back on the show to answer your questions and give his take on our favorite topics: oil, coal, precious metals, uranium, and dividend stocks. Rick has 5 decades of experience betting on the natural resource sector. Rick, thank you for coming back on the show.
Steve, thank you for having me back. I enjoy these sessions.
Yes, the pleasure's all on this side of the table, sir. I got to say, I'm really excited. I've got all my stuff printed out here, the itinerary for the Rural Symposium, July 7 through 11. We also have a live stream if people can't make it in person. What can we expect for the Rural Symposium this July?
I'm told this is something like the 28th year that we put the thing on, Steve. And I want to say, first of all, that we try and make it a little better every year. We poll the hell out of our attendees. And truthfully, most of the good ideas over 28 years for improving the symposium have come from our attendees. It seems that rich people are pretty generous about giving you information as to how you can serve them better. And we've taken that information to heart. So let's start by saying that over 28 years, we've built a great core of returning attendees. This is important because the idea at a conference that all the information comes off the dais out to the auditorium is stupid. Whether you attend live or whether you attend live stream and participate in the chat rooms, you will discover that your fellow attendees have an awful lot of wisdom to share. People who are wealthy trying to get wealthier, or people who are trying to save what they have, are people that have experience around the same topics that interest you. On the dais, however, we have wonderful big picture thinkers who talk about the way the world is, not the way that NBC or CBS or CBC or the BBC would like you to believe, but rather the way the world is. Jim Rickards will be there, of course, talking about the financial structure of Wall Street. Why should we care? Well, he was general counsel for long-term capital management. He damn near brought down Wall Street. If you want to see a guy who can describe the stresses, talk to one who created a bunch of them. Nomi Prinz, talking about the structure of Wall Street. How does she know? Well, she was a partner at Goldman Sachs, an analyst at Goldman Sachs. Daniela DiMartino Booth talks about the Fed. Why should I care what she has to say about the Fed? Because she worked at the Fed. She wrote some of those reports that you read coming out of the Dallas Fed years ago. That's how. So that's important. After you have had your mind refreshed with how the way the world really works, as opposed to the way that popular media would have you work, we talk about strategies. We have real world analysts and portfolio managers who've made lots of money in natural resources over 30 years. Not some failed freak who couldn't do technology well and couldn't do consumer durables and parachuted into resources where he or she couldn't do any damage, but rather high quality people. Every one of our exhibitors is vetted. The qualification at every other investment conference I know to be an exhibitor is a check that cashes. We have vetted every public company issuer to the extent that we own stock in every single exhibitor on the floor. If we won't part with our own money, we don't let them come try to talk you out of yours. No guarantee because I own stock that goes up, but it sure guarantees that the process is honest. Then, of course, the living legends, people who have built multi-billion-dollar mining companies from scratch. People who have taken companies from $2 million pre-money valuations to $5 billion. Managers that have literally added 3 zeros to their market cap. Why is this important? Because they teach you the lessons that they learned, and they teach you how to identify early stage ventures before they become large and successful ventures. Nobody knows this better than they do. All of these things come together so that I can tell you, first of all, we're going to give you 60 or so hours of programming over 4 days, more than you can absorb. But we're going to tape everything, even the breakout sessions, so that you'll be able to use the conference material after the conference. In other words, you'll be able to wring every ounce of educational value out of the conference from the tapes. And whether or not you attend live or in the comfort of your and convenience of your own home, like 1,000 other people did last year, comes with an ironclad money-back guarantee. If the combination of being in the company of people like yourself who you can learn from, or the big picture paradigm, or the analysts, or the living legends. If for any reason at all you don't think that I've delivered value, email me. I'll give you your money back. There's no other investment conference that I know in the world that has a no questions asked, gold-plated money back guarantee. But we do. Whether you attend live, July 7th through 11 in Boca Raton, Florida, or whether you access technology and participate in the conference from the comfort and convenience of your own home. By the way, we have a dedicated online host this year, Paul Harris from Mining Journal, who will give you a curated experience online. However you do it, we're going to give you more content than you can absorb, but we're going to give you the ability to absorb it again and again and again. Remember, too, every public company exhibitor is being interviewed by myself before the conference, so that you'll have the ability to familiarize yourself with the type of people that you'd like to talk to and potentially invest in before the conference, which will make your conference time more efficient. And finally, the conjunction of all this 28 years of effort and value means that we offer you a gold-plated money-back guarantee.
I really appreciate those interviews that you've been doing. I've been absorbing them like a sponge on water, and it's given me a real kind of precursor to what to expect for the symposium. So thank you for that, and also thank you for the private room. I know a lot of listeners have signed up. I'm in room 180. Come by and say hi. I'd love to meet you face to face. So look forward to it, Rick. 1 month away. That's exciting.
Thank you. I really encourage people to preview the interviews. You know, we're a prisoner of the tyranny of time at the conference. We have more to teach you, more to show you, more people to introduce you to than we can accomplish in 4 days. The idea that you watch as many of the interviews as is possible when it's convenient for you, study the issuers before the conference, even reach out to the issuers before the conference, will allow you to maximize the benefit that you generate out of the 4 days of the conference. What you put into the conference will determine what you get out of the conference. We're doing everything we possibly can to give you the tools to make the most money possible from this conference.
Yeah, and make sure as a listener you pay attention to our community tab. I'll be posting up which companies we'll be interviewing, offer suggestions there, questions, and I'll ask the CEO themselves. So look forward to it. There's a link in the pinned comment below. I hope to see you there. We also have your private placement boot camp coming up. I've been excited about this one. Go ahead and give us a quick 101 on what a private placement is and how is this boot camp August 24th going to make us money like all previous boot camps?
First of all, this boot camp will be primarily for accredited investors. You don't have to prove to me that you are an accredited investor. You can be an aspiring accredited investor. Save the information for future utilization. But in order to qualify to participate in private placements, normally one has to have a portfolio valued in excess of $1 million, exclusive of home furniture and fixtures. What is a private placement? A private placement is an issuance of securities, either debt or equity, directly from the company rather than from another investor in the aftermarket. A private transaction suggests that it is an offering that hasn't been cleared by public prospectus. That means it's quicker and easier for the issuer, and often that is reflected in better deal terms in private placements than one could obtain in public offerings. It's worthwhile to note that usually the equity securities that are issued in the conjunction with the private placement are restricted for some period of time for resale. So you need to be able to tolerate illiquidity. Why would you do a private placement? Well, first of all, these private placements are often opportunistic from the company's viewpoint, meaning that they have the opportunity to use a capital infusion to do something on a timely basis, which could change dramatically the value of the business. So the fact is that there's the probability, not the probability, but the possibility that you're contributing catalytic capital, and just in time catalytic capital. I've seen that happen mercifully for me numerous times in my career. These are often purpose-driven. And to the extent that they're successful with regards to the purpose, what that means is that the market timing around private placements can be absolutely exquisite. The second thing is that in thinly held securities, you're buying securities at a pre-negotiated price and term, which means that you don't have to subject yourself to the vagaries of the market as to whether or not you'll get a position. You know you'll get a position. Third, however, at least with regards to equities private placement, a well-structured private placement contains a warrant. What is a warrant? That's the right, but not the obligation, to buy more stock over a fixed period of time, so that to the extent that the capital that you contributed does make a catalytic difference to the company, you get to benefit twice. You get to buy more securities at a fixed price over a fixed period of time. You don't have to buy it. So if the company's unsuccessful, you don't double down on your mistake. You just double up on the ones where you've been correct. I need to say that as a speculator going back 50 years, while I've done a reasonable amount of on-market trading, in fact, a lot of on-market trading, the bulk of the speculative profits that I have enjoyed in 50 years in natural resource equities has come from private placements. For those of your listeners who don't know what our boot camps are, our boot camps are 8 or 8.5 hour online deep dives into various topics around natural resource investing and speculating. We've done a uranium boot camp, we've done a silver boot camp, a prospect generators boot camp, a developers boot camp, a royalty and streaming boot camp. They're deep dives. This one's different because in every other boot camp, I've brought in third-party keynote speakers, people who deliver the initial lecture to cause people to understand it. I thought a lot about private placements, and the best keynote speaker I know in the private placement business is this guy named Rick Rule. I know him pretty well. He's done a lot of them. And so I will be my own keynote speaker this year. And I'll talk to you about a range of private placement techniques, how to do it, how to do due diligence, what to watch out for, what to do after you've subscribed for private placements. I'll talk about debt placements. I'll talk about equity placements. And I need to say that I talk about this with very, very deep experience, having structured and participated in literally hundreds of debt and equity offerings over my 50 years in the space.
Awesome. I look forward to it. Every boot camp is always fun and educational and profitable as well, which it's nice to see the bank account go up. So that will be August 24th. If you can't make August 24th, it'll be recorded and you can watch it as many times as you want. There's a link in the pinned comment below. So look forward to that one, Rick. We have a lot of listener questions here. I did an episode recently where I kind of delved into some dividend stocks. And so I think that spurred some of these questions. I like questions like this when they're asking about two different companies. I think they're basically saying, hey, Rick, I got an extra hour a month to study one of these companies, but I don't have an extra 2 hours a month to study both of them. So YT wants to know, what would be a better option as a business, a pipeline company like Enbridge or a royalty company like Freehold?
That really depends on what your goal is. The distribution income from a pipeline is normally more consistent than from a royalty company. You could say, in effect, that pipelines are infrastructure royalties in the sense that they aggregate material from a bunch of producers, they move it from point A to point B, and usually the transportation route that they have is at least an oligopoly, if not a monopoly. Usually, too, because of the multiplicity of sources of revenue, the revenues are more consistent and of longer duration. On the other hand, what a pipeline seldom gives you is access to quantum increases in value, which can occur as a consequence of exploration and development success in the royalty business. So while I know that listeners always want a one-size-fits-all answer, as always, the answer to that question really depends on the goals and tolerances of the person asking the question.
Okay, so you're saying basically in this scenario, Enbridge might be a little bit more consistent, but Freehold could have more upside?
Absolutely. I think Freehold is selling at a greater discount to tangible values than Enbridge. But I think that Enbridge will have steadier and more reliable income and hence distribution growth.
Okay. What ranking would you give the two of them?
I have Enbridge at a 5. I have Freehold at a 4.
Okay. All right. And Gudu has a similar question. He says, Rick's opinion on Ecopetrol versus Petrobras.
I have no opinion between those two. They both exhibit real political risk in the sense that in Brazil, as an example, Lula, the president of Brazil, is an admitted socialist. The largest shareholder in Petrobras is the government of Brazil. And Mr. Lula would like more money for the state, which isn't necessarily good for shareholders. In Ecopetrol, the ruling party in Ecuador is very much in favor of progress and resource development, but there are lots of regional challenges stemming from the fact that traditionally in Ecuador, the social benefit from extractive industries like mining and oil and gas has flowed to the capital, while the regions who bore the cost often didn't share in the revenue. The consequence of that is that there are political challenges around oil production in those western flanks of the Amazon basin that Ecopetrol operates in that are longstanding and difficult. In both cases, the companies enjoy, at today's prices, very good free cash flows, and they've been fairly generous at passing them on to shareholders. Neither company has reinvested enough money out of their free cash flow in sustaining capital or new project investments. So you need to understand that both of those dividends are fairly fragile in the 3 to 5 year time frame.
Okay. Okay. So you could see some fragile. I'm going to share my screen here, and I'll pull up both of them so that we can see just the leverage that we have here with the dividends. If we take the COVID low when oil was free, Ecopetrol went up 89%. Now, if we adjust for dividends here, this is pretty incredible. The COVID low, and instead of 89%, we have over 200. And Petrobras is something similar. But you could see in the 3 to 5 year time frame that that could be.
What you need to be concerned about in the context of both companies, the high dividend yields are, of course, very appealing because you get paid now. The difficulty is both the fact that neither company is reinvesting sufficient capital in sustained capital in new project investment. And the perhaps troubling aspect of that is why. If the companies respectively see increasing political challenges ahead, it might be more efficient for them to decapitalize the company and distribute the capital to shareholders rather than reinvest the capital in an increasingly challenging political environment. I'm not saying that's true, but sometimes you see companies, in effect, begin to self-liquidate because the reinvestment opportunities are so challenging politically that they think it's in their best interest to return capital to shareholders. I'm not saying that applies to either Ecopetrol or Petrobras, but it is something that concerns me.
Okay, yeah, that was a bit of a red flag for me too, because when you look at their payout ratio percentage, it's quite high, which unless I'm reading it wrong, it looks like they're paying out more than they're bringing in.
Well, I think that they're making their distribution based on cash flow as opposed to profit, which is to say that's another function of really lack of sustaining capital investment. They have fairly high depreciation depletion charges, and rather than reinvesting that money, they're distributing it to shareholders.
Okay.
I don't know enough about Ecopetrol's exploration opportunities. I don't know very much about their project pipeline. I know that Petrobras has superb reinvestment opportunities in front of them. And the fact that they aren't exploiting them more aggressively is troubling to me.
Okay. What ranking would you give the two of them?
I don't have Ecopetrol rated. Petrobras, I have a 5, and I'm looking at a downgrade. On a valuation basis, it's cheap. I'm just very concerned about the lack of sustaining capital in new project investment.
Okay. All righty. Leixabet. Have you completed work on Woodside?
No.
Okay. We can go off of that one.
That's a large and complex challenge.
Yeah. Okay. Any other dividend stocks that come to mind before we move on?
Well, a wonderful combination of current and increasing yield and Sustaining Capital Investments, ExxonMobil. I know it's a boring name, but at 71 years of age, I sort of consider boredom to be the other side of terror. And I prefer boredom to terror. Their refining and marketing business is in good shape. Their upstream business is in superb shape. The idea that they could make a discovery in Guyana that is big enough to move the needle for a company the size of ExxonMobil is amazing. And then on top of that, rather than decapitalizing their business, they spend $60 billion to buy Pioneer to double up on their Permian Basin activities. You know, for some investors, this is the only oil stock they need to own. They have a wonderful 30-year track record of capital allocation, and all of their businesses are in good condition. They have said that they will increase returns to shareholders by 14% this year, either by way of share buybacks or increased dividends. And despite the fact that they're doing that, they're spending billions of dollars in Guyana, tens of billions of dollars in the Permian, and they're maintaining, sustaining, and new project capital investments everywhere else. Truly stunning financial performance.
Yeah, and the share price recently has had a nice knockoff, so that's been exciting.
Yeah, now, you know, people who are concerned about volatility shouldn't invest in stocks at all. You know, could Exxon fall 20 or 25% in price before it recovers? Absolutely. You own a company like Exxon because you want to become wealthy over time. You want to provide you for your family. You aren't looking for gratification before the next long weekend in a stock like Exxon.
Yeah, and as the share price falls, assuming that they don't cut their dividend, you actually get a higher yield. So pretty cool. What ranking do you have them?
I have Exxon as a 4.
Nice. Okay, moving on to coal. Oh, this might go in the dividend. Alliance Resource Partners. Do you follow them?
I do. I do.
What do you think?
I don't own Alliance, although I wouldn't discourage it. The reason I don't own it is in industrial materials companies, I want my companies to be in the lowest cost quartile worldwide. Alliance is an American producer, and as a consequence of that, they aren't in the bottom quartile. They are very successful operators, but they also operate what I would consider to be second-tier mines. They get away with operating second-tier mines because they have superb infrastructure. They sell their product both into U.S. markets and into European markets, and the geographic locale of their coal fields means that they're unusually profitable as a consequence of their access to excellent existing American infrastructure. But I don't own them.
Okay. Yeah, I saw the dividend was like 12% or something. And okay. Adam wants to know, could you give your take on Warrior Met Coal?
I don't know enough about Warrior to comment.
Okay. Stillwater Critical Minerals.
I'm not a Stillwater shareholder. I'm sympathetic to the idea of continuing to explore the Stillwater complex, but I'm not a Stillwater shareholder.
Okay. All right, moving on. I got this one under gold and copper royalties. So Daniel, this one got a lot of traction. Daniel wants to know his opinion on Gold Royalty Corporation and the Varus copper stream.
The Varus copper stream was a fairly retail purchase, which is to say it was a very good asset at a fair price, not a great price. I believe that the money that Amir Adnani has spent over the decades on investor relations will allow him to do a bit of, how would you call it, alchemy. In other words, I think that the free cash flow from the copper royalty will be valued on gold metrics, which is nice work if you can get it. With regards to gold royalty, I'm increasingly attracted to it simply because the share price has declined fairly well. 3 years ago, 3.5 years ago, that stock was very, very overpriced. They were smart enough to use that premium valuation to acquire other royalty and streaming companies who had been less efficient stock promoters. The consolidation of those assets, the growth of the company's size, when combined with the share price deterioration over 3 years, has seen that stock go from a 7 in my book, which is to say stupidly overpriced, down to a 5 with possible reversion to a 4. It's useful to note, too, that Gold Royalty and its sister company, Gold Mining Inc., have a strategy now, having acquired a bunch of gold projects when gold was deeply out of favor, of finding ways to monetize or advance those projects now that the gold price is higher. What that means is that the time to pay off with regards to those assets is much more proximal and much more visible than it was in the past.
Okay, yeah, as I took it, it seems like it's going to take about 5 years to pay off that debt, but the mine life is about 18 years. So you got,
And what you see with ore bodies like that is frequently that they were put into production as soon as they could. In other words, as soon as the company had drilled off enough reserves and resources that they could see a reasonable return on capital employed. That doesn't mean that they have found, at the time they put the mine in production, all of the reserves and resources that they're going to enjoy. Good deposits like that generally tend to grow, which is to say, it is not unlikely that after 10 years, they'll have the same level of reserves and resources on the books that they do now. That has no net present value, but it's important to note that after you've run out the decline curve, the depreciation curve, pardon me, after you've used up the discounted net present value, that you restart the clock at the same number. The tail end of those assets is almost always unvalued by the market.
okay, so 18 years might even be a little short.
I suspect that that's a 25 or 30-year ore body.
Oh, wow. Okay. And it's paid off in 5. All right. Another copper gold royalty. David and Danny want to know. Would like to hear Rick's thoughts on the quality of Metalla Royalties copper assets and what he thinks Metalla's net present value is compared to market cap.
I don't know enough about Metalla's copper assets to comment. Metalla generated just absolutely superb market capitalization early in its time. The consequence of that is that the company at one point in time was selling at about 4 times its net asset value. At that period in time, I became an ex-shareholder. So I will revisit Metalla. I know that they've done a good job on project acquisition. They have extended their reserve life. You'll remember that when they started paying a dividend immediately, but they started paying a dividend out of a deposit with a 2-year reserve life, which wasn't too appealing to me. They have used that market cap to acquire a large royalty portfolio and then acquired 2 a base metals royalty company that the same team formed. So it's a much more viable company. But I need to say that I don't know enough about it to attempt to arrive at net asset value.
Okay. All right, moving on to silver. Any updates on PanAmerican silver? Silver has had a heck of a run, and 6 months ago when you were excited because it was hated, now we're up at 31, $32, and these miners that we've been holding have just killed it. Any updates on PanAmerican?
I mean, PanAmerican's cash flow response to the increase in gold and silver prices has been wonderful. The company's done a very good job of keeping costs under control. And not every company that we follow has been able to do that. You would think with increases in the gold and silver price, the way we've seen it, that cash flows would increase. But at some companies, the operating expense associated with extracting that gold and silver has kept pace with the increase in the gold and silver price. At PanAmerican, mercifully, that hasn't been the case. The market hasn't kept pace. And I think the market hasn't kept pace really for 2 reasons. One, increasingly, the market understands that over 65% of the revenue at PanAmerican Silver is gold.
It's gold.
It's less and less a silver company, and the market is starting to take away the premium valuation to PanAmerican that was associated with the fact that a preponderance of its revenues used to be silver. The second thing is political challenges in Mexico. AMLO, the prior president, was no friend of mining, and the new president of Mexico is an enemy of mining. Given that a fair number of the assets in PanAmerican, including, of course, La Colorada, are in Mexico, that is at least a perception headwind. One of the attractions of PanAmerican to me is that there's some icing on the cake that you get for free, which is to say a deposit in Argentina, which is improving rapidly politically, that has 500 million ounces of high-grade silver. And that isn't baked into the cake at PanAmerican at all because they've been trying for 15 years to put it into production. My hope is that Milei and the new political realities of Argentina mean that the Argentines finally will be rational with regards to resource development, which would be wonderful for PanAmerican. The second is a deposit in Guatemala, which is also 500 million ounces of high-grade silver. If PanAmerican can solve the political challenges at both the national and the local level in Guatemala or in Argentina, the truth is that they have 1 billion ounces of high-grade silver in 2 different deposits, which don't factor into the valuation at all. If either of those projects came into production, either of them would double PanAmerican's silver production. If by some odd set of circumstances over the next 5 years, both of them came into production, and I'm not saying that's going to happen, a truly spectacular thing would happen. What I love about it is that the upside represented by those two projects is not baked into the market cap at all.
Yeah, Escobal in Guatemala and Navidad down in Argentina. I got to believe that Milei can only be beneficial to that.
Well, I mean, they need Milei, and Milei needs them. Everything that he's done in the country is wonderful, but the country has no money.
Yeah.
And extractive industries, in particular, the Vaca Muerta shales, oil and gas shales, offer the way out for Argentina in conjunction with what Milei has done with regards to the federal government, and also what he's done with regards to expectation. What you need now in Argentina is to add some money back into the equation. Mining in the high Andes, lithium mining, copper gold porphyries, and of course this massive epithermal gold field, in conjunction with that oil and gas, offer Argentina and Milei a way out of their current dilemma.
Yeah. Pull money out of the ground. Use Navidad to do it. Okay, Acta non verba. He says, scores on a few companies that will be attending the Rural Symposium. He's got Orogen Royalties here.
I have Orogen as a 4. It might get downgraded to a 5 simply because the stock has performed so well. It might also do better in the sense that they have a royalty on a spectacular developing gold deposit, the Silicon deposit being explored by Anglo Gold in Nevada. The best Nevada discovery in a decade, and the story is still being written. On the one hand, I'm a little nervous about the share price performance of Orogen, which has been stunning. Yeah. It feels good that stuff goes up, but that makes it no longer so cheap. On the other hand, one of the reasons it's going up is nobody has any idea, myself included, how big this Anglo discovery is going to be. So I have it as a 4. Big deposits tend to get bigger. They also tend to get richer. So I'm an optimist with regards to that. But I would note, and your questioner should note, the stock chart on that is awful steep from the lower left to the upper right.
Yeah, it's been really nice. It's been fun to participate. So thank you for that boot camp, which turned me on to it. Okay, and GoGold.
I think GoGold is cheap. The problem is that they will be developing a gold camp in Mexico, where the current president is anti-mining, in particular anti-open pit mining. And there is a probability that some of the mines in that camp will begin their lives as open pit before they go underground. So there are real political challenges, and there are also perception challenges. Note that I'm a pretty decent sized GoGold shareholder.
Okay. What ranking would you give it?
I have GoGold as a 4, looking to downgrade it to a 5 as a consequence of uncertain politics.
Okay. All right. PGMs, Platinum Group Metals. John wants to know, he says, hey, Rick, while it's clear you're bullish on PGMs over the next 5 years, do you have a different outlook when comparing platinum versus palladium?
Only that platinum is cheaper than palladium. There was a time earlier in my career when palladium was cheaper than platinum. And what happened is that fabricators developed a bunch of fabrication technologies to use palladium. And hence, demand for it went up relative to platinum, and the platinum price went up. The palladium price went up. The platinum price went down. The reverse is happening now. Fabricators are looking to increase the utilization of platinum at the expense of palladium. So the truth is, I'm fairly agnostic.
Okay, you kind of put both of them into the same category.
I do. Yeah.
Okay. All right. The easiest way to bet on that is the SPPP brought to our friends at Spot. And fiat is dead. I love that screen name. That man knows the difference between money and currency. He says, hey, Steve, please ask Rick if he's heard any updates on the Amplats breakoff from Anglo American. I know Anglo rejected all bids from BHP, but Anglo still plans to divest Amplats. What usually happens in these spinoffs?
Well, this particular spinoff is going to be very interesting. South Africa, in mining parlance, is between a rock and a hard place. The government and society itself hasn't decided how the benefits of mining are going to be distributed through society. What that means is that the companies who are forced to make fairly expensive capital allocation decisions have a difficult time doing so because they don't know who's going to own the asset 5 years from now, 6 years from now, or 10 years from now. In the case of the platinum business, it's very clear that workers' wages have to go up, but they can't because the politics of South Africa preclude making the capital investments that would allocate the work, that would allow the workers to be more efficient. I think that Anglo American is probably wise to segregate the South African business units because I think the market values them at less than nothing. And there's a range of attractive assets there. I think also that depending on how they spin them out and how they chop up the social benefit associated, as an example, with their platinum business or their other South African assets, that they may be treated more gently internally in South Africa with regard to their non-South African assets, which is a fancy way of saying if you elegantly somehow bribe various social groups in South Africa for the assets that are in South Africa, they may be more gentle to you with the non-South African assets.
Okay, yeah, and just to clarify, this asset is pretty much platinum, and so Anglo's has had offers from BHP, of which they've politely declined, and it looks like they're selling this as a way to generate some cash. Is that?
Yeah, I mean, everybody wants their copper assets worldwide, and they would like to keep them. There are two assets, the broad assets within South Africa, the De Beers diamond complex, and these platinum assets that are really subject to the vagaries of South African politics. And none of the acquirers particularly want to deal with that. Probably means that the successor managers, assuming that some accommodation with the South African government has been made, can extract some value from them. But clearly people not from there can't. And there's no way that an observer like me prior to the transaction can forecast what that transaction would look like.
Okay. All righty. PGMs. Okay, and moving on to uranium. Okay, I'm going to give a shout out here to your classroom. Guitar Freak wants to know, he says, appreciate all the insight you bring. Curious if Rick has or will talk to the executives at NexGen about their expenditures. And you just did an episode with Leigh Curyer and basically asked him all of that over at the Rural Classroom. There's a link in the notes below. Just go over to the Rural Classroom. And if you're not a part of there, you got to ask yourself, what are you doing? You get Rick several times a week. It's awesome. And what's maybe a couple minutes of your takeaway after your conversation with Leigh?
Well, first of all, I applaud Leigh for having the balls to deal with the topic forthrightly. I didn't have to approach him. He said, Rick, you're well known as a skeptical observer. There's a lot of hostility around this financing, and I'd like to discuss it on your show. In other words, I'd like to go right into the Dragon's Den and deal with it.
That's a good sign.
That took guts. He is an accountant by background, and he was able to answer my questions factually as opposed to in narrative. I'm not suggesting that I was happy with all of the responses, but I would say I was happy with 85% of the responses, which is frankly better than I thought I would feel afterwards. In particular, his rationale for the financing. Well, I thought it was a really expensive financing. When I asked myself about the financing, I said, would I have participated in that financing? In other words, if I were asked, would I have participated? The answer to that is hell yes. um, I asked him point blank if this was the last financing that they would need to do before production, because clearly the case that he made numerically, I'm not talking about net present value, but numerically, was that the projected cash flows from this deposit at $75 uranium, not at current spot, but at $75 uranium, would support on a price cash flow basis a $30 billion market cap. You're talking today about a $6 billion market cap. So if you think that you could trade for a 30 billion cap, you're selling at a 6 billion cap. Any financing that you do that dilutes the shareholders' access to that $30 billion or reduces their proportionate interest is dilutive. He told me that he believes this will be a $2.2 to $2.4 billion build, that there is at least $1.8 billion available by way of conventional debt. And he suggests that with their existing $630, $640 million in cash, that they are financed to construction and to completion. He described the financing that they just completed. For those of your listeners who don't know, they raised $260 million in a convertible preferred with the conversion 30% above market, but paying a 9% coupon. And they turned around and put the proceeds in uranium. In other words, they bought physical uranium. Now, this is not buying physical uranium the way that Miradnani did at $25. This is buying physical uranium at $80 plus. The answer he gave was the answer that I was hoping was true, which is to say that the purchase of uranium was done to secure uranium offtake agreements with utilities who are afraid that the ramp up of the mine won't go as scheduled and want to make sure that if they have an offtake agreement in place and that is part of their feeding schedule, that they have access to the fuel. If that's true, and I have no reason to doubt it's true, then the financing, while expensive, was strategic and goes to the end of building the mine. What I think is instructive for people too, this isn't an answer to the question, I'm just using the question as a platform for a statement, is the emergence of a term market in uranium means that an issuer that didn't have a prayer of being able to build a mine before now has access to the money. In uranium with term markets, the companies can lock in price and volume, minimum price and volume, for 15 to 20 years in the future. And if you have that term contract with an investment grade counterparty, Tokyo Electric Power, Southern Company, Duke Power, you literally can take that contract to the bank. What that means is that NexGen, when they threatened to build the project, a threat that 5 or 6 years ago would have been laughed at. You know, here's a bunch of explorationists that think they're going to build a mine, ha ha. With the emergence of contractors who will build that mine for a fixed price and the ability to lock in the price that they sell the uranium for on the other side, all of a sudden, NexGen can make an absolutely believable threat with regards to building the mine. What that means is that an acquirer, a potential acquirer who looks at the company and says, yeah, right, you're going to build it, can say, oh, there are financial alternatives. And the bid that we put up has to have a better adjusted risk-adjusted net present value than building the deposit oneself. So there is a level of dynamic tension in the market with NexGen and the other development stage companies that isn't present in any other commodity and wasn't present in the uranium business 5 years ago. It's a very important change that your listeners need to understand.
Yeah. Okay. So I was questioning the physical uranium purchase as well, but basically he's saying like, hey, we've got contracts going out in, I don't remember what it was, 2029 or something, and by us having this on the books, then they know that we can deliver it. Whereas if there's some hiccups or something with construction and it takes a little bit longer, at least we can deliver on those contracts because we physically have it now, than having to rely on everything going on time.
They could even pledge it.
They could even what?
Pledge it.
Pledge it.
Pledge it. They can commit it to the contract.
Ah, okay. Okay.
You use it in effect to secure part of their obligation.
Huh. Okay. All right. Cool. Thank you. Yeah, watch the full interview, 45 minutes long at the Rural Classroom. All righty. Prigler wants to know, what does Rick think about Boss Energy after the recent insider selling?
I don't like to see that level of insider selling. I understand perfectly their rationale. They built the company over 6 years, sold no stock. They did their job, and now they want their reward. I sold enough Boss, I don't know, 9 months ago, 10 months ago, that I didn't have any cost left in it. I sold enough of the stock that I recouped all my capital. And by the way, I recouped my capital gains bill too. When I saw them sell 75% of their stock, I sold 75% of my stock that remained. So I have a much smaller piece. I figure I did my job too. I was alongside them, gave them money when they needed it. They've decided to harvest some, so I've decided to harvest some.
That's a good way to look at it. I like that. I like that a lot. What ranking would you give them?
I have bosses of 5.
Okay.
I mean, they've done a great job. And they are coming into the contracting round now. So I'll likely look stupid 6 months from now. They will likely have sold term contracts in a way that allows the market to value the company accurately. That's likely higher than it was now. But not having access to that information and looking at the actions of highly informed people that did have access to information, I decided to do what they did.
Right on. Okay, we got a lot of questions on Integra Resources.
I'm a big fan of George Salamis. I've been around him a long time. He's made me a lot of money. I like oxide gold deposits. I wish the grade was a little better. My suspicion is when they drill it tighter, it will get a little better. I need to say, I'm going out there to take a look at it in about 10 days.
Oh, cool.
Take a look at it with my own eyes. I don't like these great big analyst tours, where there's 30 people out there and they got to entertain everybody. And, you're more likely to go to a strip club than you are a mine site. So I'm going out with George by myself, kick some rocks. I'll have a much better sense, but I'm very, very positively inclined. I like the metallurgy associated with this deposit. I like the infrastructure associated with the deposit. I kind of wish it wasn't in Idaho. I kind of wish it was in Nevada, but it ain't. So, you take what you get. I like the topography of the deposit. I like the fact that mostly you're moving rock downhill. In other words, your chief energy source is gravity as opposed to petroleum. I like that a lot. And I'll have a much better feel for it, I think, when I can see it.
Okay. That's interesting. I've never thought of that, but that makes perfect sense. Gravity's free and diesel's expensive.
Yeah. Yeah. To the extent that you can move rock downhill as opposed to uphill, it's a very good thing.
Yeah.
You don't wear out gravity.
Okay, Sebastian wants to know, do you follow the diamond market?
I don't.
Okay.
I did okay. Well, actually, I did very well. I got very lucky in diamond exploration years and years and years ago, which caused people to think I knew something about diamonds. The truth was, I bet on some explorationists and I got lucky. Diamonds are, they're almost a consumer good. I can't dress myself. So the idea that I would understand something about consumer trends, not a non-starter. It's not what I do. Talk to me about coal or copper, not diamonds.
Okay. All right. We got a few here, I think, for the lightning round. Let's start off with hot chili.
Likely higher. The copper price might level off here for a while, but 5 years from now, the copper price, I think, absent a recession or depression, is going to be much higher. Hot chili's reached critical mass now. It's a big, big, big deposit or complex of deposits. Importantly, great access to infrastructures on the PanAmerican Highway. It's next to a town full of copper miners. Got access to lots and lots and lots of water. a water source called the Pacific Ocean. It's about 30 kilometers from tidewater, which means they can ship the stuff. It's got everything going for it. I think, too, the size of the deposit, or rather the deposits, gives them access to exploration upside to supply what's missing, which is to say a high-grade starter pit at decent enough grade that they recoup the project capital in 2 years or 2.5 years. I think that'll come. So I'm quite attracted to Hot Chili.
Okay, and their ranking?
I have Hot Chili as a 4.
Fours are good.
Fours are
Okay,
good.
Centaurus Metals.
I love Centaurus. Um, Centaurus is a potential tier 1 deposit, as is Hot Chili. By the way, tier 1 defined by me is in excess of $10 billion in recoverable reserves and resources in situ at today's commodity prices, with all-in sustaining costs in the best quartile in its respective commodity, and returns on capital employed in the best quartile, but at least 25%. Centaurus qualifies. It qualifies in particular, too, as an ultramafic deposit, nickel and platinum and palladium centric, when those commodities are deeply, deeply, deeply out of favor. I'm particularly attracted to PGMs and nickel that aren't located in South Africa, Zimbabwe, or Russia. This one happens to be located in Brazil. I'm more attracted to the fact, ironically, that it's down fairly substantially in price from the price I paid for it. The idea that I can utilize the same intellectual capital to increase the allocation of physical capital to a project that I have a lot of time for is really as good as it gets for me.
Yeah, I'm seeing now the level of I don't know, disdain, or I'm not sure what the word is. Hate maybe is what you call it, for nickel and the
Yep.
PGMs, and I'm getting pretty excited. This is what I saw for gold when it was down in the 1600s. You know, this is what I saw for silver when it was 18 bucks. At
You remember you and I talking 3 years ago about uranium, and the comments in social media would be, "Have these guys lost their mind?" The stuff
Yes.
is down, not up. Now, it's weird, when somebody goes to buy a winter coat or they go to buy groceries, they want to buy stuff on sale. When they buy commodities in stock, they want to pay too much.
Yep.
It's truly an odd phenomenon.
Yeah, yeah, it's making me excited. How much time we got? Okay, Seabridge Gold.
Seabridge, I have as a 5. If you are a believer in sharply higher gold prices in the near term, then Seabridge is really cheap. This is an incredible, incredible gold deposit. The difficulty is the grade and the upfront capital costs. It'll be at least $8 billion to build this. And recovery of capital is constrained, A, because of the large amount of capital that goes in, but B, also because of the average grade. It's worthy to note that they have a pretty good size exploration budget, which is a good thing. On the southwestern flank of that deposit, if my memory serves me well, the Brucejack Fault, which is one place where there was good ground preparation so that the gold-bearing fluids could concentrate as opposed to disperse, Pretium discovered 6 million ounces of high-grade gold. The chance that reoccurs elsewhere at Kersolverets or snowfields is 100%. Do they find it? How long does it take for them to find it? All that kind of stuff. This is the ultimate leverage to the gold price stock. I, for myself, don't pay as much for leverage as I did in 1990, 1991, when leverage was in fact cheaper. But if you want one vehicle to participate really dramatically in the upside in the gold price, this would be it. You're talking about an accumulation of gold that's comfortably in excess of 100 million ounces, silver comfortably in excess of 1 billion ounces, with a large, large, large copper credit, and a deposit that really hasn't been explored very thoroughly. I mean, it has a lot more to give. The sort of ultimate gold rodeo. This will be really volatile. It'll be really challenging. If the gold price fell, you could lose a lot of money, not a little money. If the gold price rises, or if they get lucky with their exploration, you could make a lot of money. It's also run by a very honest, very smart guy.
Adrian Day said a similar thing. He said basically, it's a really nice optionality play
Yep,
on it,
that's
to
what it
the
is.
up and downside.
That's what it is.
To the up and downside. All right. Well, thank you very much, Rick. Oh, what was your ranking on Centaurus? I forgot to get that.
I have Centaurus as a 4.
Okay.
The deposit size is goofy. It really truly is goofy. The exploration upside is goofy. It'll take them a couple of years to really have. I mean, you'll have information before then, but it'll take them a couple of years before the deposit is ready to build. By which time, perhaps the malaise and the nickel price, the platinum palladium price will be over.
Yeah. Okay. Okay. That's the risk you take. All righty. Well, thank you very much, Rick. Any final thoughts?
No, that's it. I just, I want to tell people that I think they're sort of in a sweet spot here. You've seen commodity prices run without commodities equity prices running as much. With regards to the gold industry, it's easy to understand. The buyers that have taken the gold price up have been foreign central banks, that they don't buy stock. People have wondered why the gold has run and the stocks haven't run. Well, there's a very, very, very simple answer. Historically, gold needs to lead a bull market. And you have now in the last 9 or 10 weeks seen increasing retail participation in the gold market. If that continues and the gold market continues higher, which I think it will, you will see the money cascade down the trail into the mining stocks. I think in the very near term, you're going to have fairly mixed operating results in the gold space. You're going to have the high quality producers that pay attention to cost, the Agnico Eagles of the world, the Alamoses of the world, deliver quarterly results that'll surprise people in a positive sense. You'll have some other companies that surprise people in a negative sense because although the gold prices increase, the cost of producing gold has increased too. But I think that you're going to see follow through between commodity price increases and equity price increases over the course of a year or a year and a half that are fairly broad spread. Nobody is anticipating that right now among generalist investors. So you have the ability to front run investor sentiment in a way right now that you haven't had for some time. And you likely won't have again once this once this bull market, materials bull market gets underway in earnest. Dividend investors also should be looking at the resource space. They should be looking at companies that are able to generate competitive yields with less than 35% of cash flow, companies that have adequate capital to reinvest and are reinvesting adequately. The dividend levels that you're seeing in these companies are both sustainable, if they choose to, and generous, and that's a wonderful combination.
Yeah, yeah. Going back to what you're saying about the cycle, that we saw it with uranium. The commodity itself moves first,
Yep.
then the major players, and then now we're starting to see the juniors run up, and
Right.
so it follows that very predictable cycle is what I'm learning, and you're saying that we got the same thing coming for gold.
And I think we're in the sweet spot. I think that most of the people who will participate in the gold rally don't know anything about the cycles. They don't know why gold has run and why the gold stocks haven't run, not because it's hard to figure out, but because they haven't seen prior markets. They don't know where to look. I think we're in a wonderful place. I'm not trying to say that you can buy these things willy-nilly. You have to really, really, really focus because the difference in performance between the good companies and the junk is really extraordinary. But if you're prepared to do the work, if you're willing to listen to podcasts like this, read the filing statements, read the proxies, go to the rule classroom, go to our conferences. Well, the first 6 months of this year have been extraordinarily generous. And I suspect that the next 6 months will be as generous again.
Awesome. I love hearing that. Well, thank you very much, Rick. And we hope to see you at the symposium or in the live stream July 7 through 11 and at the upcoming Bootcamp August 24th. Links are in the pinned comment below. And thank you for tuning in. Share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.